Welcome back. Now in this video, I'm going to share some general thoughts surrounding value investing. When it comes to value investing, there is already a lot of free information available on the internet. But from my experience, I realize that if you're not careful in analyzing this information, then you may be misled. For example, you may already know that value investing is about investing in stocks for the long term. So the question that should come to your mind is, how long is long term? So let's try and answer this simple question. How long is long term? One of my favorite quotes on this topic comes from Warren Buffett, and it goes like this: "Our favorite holding period is forever." Now I have seen many people think that this means they should hold on to all their investments for a very long time, kind of a buy and hold forever strategy. But let me share with you an interesting statistic that relates to Warren Buffett. So some professors actually analyzed his portfolio between 1980 and 2006. They found something very interesting with respect to his average holding period for stocks over this period. Specifically, they found that his median holding period was just 1 year. In fact, only 20% of the stocks that he bought, he kept them for more than 2 years. Almost 30% of the stocks he sold within 6 months. So what do you think is happening here? On one hand, he is saying that his favorite holding period is forever. On the other hand, we are seeing that he is holding only 20% of his stock picks for more than 2 years. I actually found this quite intriguing at first, but I read a lot on this topic, and I'm going to present to you my take on this topic in this video. Now, the first thing you should realize is that when Warren Buffett says that his favorite holding period is forever, this is not exactly same as saying that he is going to hold on to each of his stock picks forever. So maybe he probably means that he would love to hold on to each of his stocks forever, but then such stocks may be hard to find, or they might be pretty rare. Also, in order to reconcile this apparent contradiction between his actions and his words, it is very important to understand a bit of his investing journey. So Warren Buffett was a student of Benjamin Graham. Benjamin Graham is regarded as father of investing, so of course Graham had a great deal of influence on Buffett's early investing life. Now, Benjamin Graham investing strategy broadly involved looking for decent businesses that are very easy to understand and buying them when they are available at bargain prices. Now, details of this strategy I will cover later in this course, but a key feature of his investing strategy was his exit strategy. Now, his exit strategy was to exit that investment if the prices rise by 50 to 60% in 2 to 3 years. However, if this 50 to 60% move does not materialize in 2 to 3 years, then he recommended that you exit your investment. So basically, Benjamin Graham had some sort of a target price for each of his investment, and also he had a time-based stop loss for every investment. So again, if you thought that the concept of stop loss is only applicable for technical analysis folks, then it seems this is not true, especially if you understand it from father of value investing perspective. Now, Buffett employed Graham's strategy extensively, especially during his early investing years. It was only after a few years that he also started using mode-based value investing. Now, mode-based value investing involves buying companies that have a sustainable competitive advantage in their business. So the idea is to buy great companies when they are available at fair prices and then hold on to them for as long as their competitive advantage sustains, which could of course theoretically be forever. Now, when it comes to this contradiction between Buffett's words, where he says that his favorite holding period is forever, while we see that his actual median turnover is just about 2 years, now this contradiction, in my opinion, can be explained to a huge extent if we consider the possibility that he still engages a lot in Graham's investment strategy. Of course, he does a lot of mode-based value investing, and he is also involved in a lot of investing in special situations which may arise from time to time in specific stocks. And if you take all this into account, you can reconcile this seeming contradiction between his action and his words. But more importantly, as far as we are concerned, it should probably make two things sufficiently clear to you. First, value investing is not about holding on to each of your stock investment forever. In fact, only a few of your investments may be so good that you hold on to them for a very, very long time, say maybe even a decade. Secondly, even in value investing, you need to have a stop loss. It is not necessary that your stop loss is a price-based stop loss. It may even be a time-based stop loss, as was in case of Benjamin Graham value investing strategy, or you may choose a time period in which you expect certain positive developments to happen, and if those developments do not happen in the time period, then you have to re-evaluate your investment and maybe even exit your investment. This will actually help you avoid a situation where you continue to hope against hope and continue to hold on to your investment without a substantial reason.